students, welcome to my live teaching learning session of Principles of Macroeconomics BECC 133. In last session, I have discussed with you what is macroeconomics and what are the major issues of macroeconomics. Today is the second session of this Principles of Macroeconomics. This is part 2. Macroeconomics, in this topic, national income accounting, you will study about economic growth, GDP, GNP, and national income accounting. Now, these are the topics of national income accounting. Now, what is the main objectives of national income accounting? Why we study these topics? Under this national income accounting, we will explain the various concepts of national income like GDP. GDP is gross domestic product. GNP is gross national product. And NNP is net national product. Now we will explain the concept of real and nominal national income under national income accounting. And the main objective of this topic is to discuss and analyze the different methods to measure national income. It means how national income can be estimated with the help of different methods. We will discuss about these methods in this topic. Next is to understand the advantages of national income calculation in global perspective. Next is to appreciate the difficulties in estimating national income accounting. These are the main objectives of this topic. Next is introduction. Now, what is national income? National income is an uncertain term which is used interchangeably with national dividend, national output, and national expenditure. On this basis, national income has been defined in a number of ways. In common parlance, national income means the total value of all the final goods and services which are produced by the normal resident of a country in an accounting year is called national income. In other words, national income can be defined by income method. We can say that the all factors income received by rendering their services in form of interest, wages, rent, and profit. If we add these factors income reward, then we can get national income. So national income is the sum total of all the final goods and services which are produced by normal resident of a country in an accounting year. Every year, national income is estimated. National income is a flow concept because it is related with per year. The concept which is related with period of time like per day, per hour, per week, per month, per year, that is called flow concept. So national income is also a flow concept because it is estimated every year. Next is how economy works. What is the flow of income? How income is flowed in our economy? If we assume that in our economy there are two sectors exist. One is firm sector and other is household sector. Firm sector produce goods and services with the help of factors of production. And household is the owner of all the factors of production. As we know that factors of productions are four. One is land, second is labor, third is capital, and fourth is entrepreneur. All the factors are owned by household sector. So household is called the owner of all the factors of production. Household provide these factors of production to the firm sector, and firm produces goods and services for household sectors, because goods and services are necessary for all human beings, because without goods and services we can't survive. So household provide all the factors of production to the firm sector, and with the help of these factors of production, firm produces goods and services and give it to household sector. In this case, household will take reward after rendering their services of factors of production in form of rent, interest, wages, and profit. So income will generate, and household will spend this income on the purchasing of goods and services. So household will do expenditure when he purchases goods and services from the market. So this type of flow continuously uh, continuously exists in the economy. That is why this is called circular flow of income. This process goes on continuously. First of all, goods are produced, after that, income will generate, and at last, household will spend money on goods and services which are produced by the firms. Again, firm will produce goods and services, and income will generate and give the income to the household sector. Again, household sector will spend money on goods and services which are produced by the farm sector. This process continuously goes on. That's why this flow is called circular flow of income. Basically, circular flow of income has two types. One is real flow and other is money flow. Real flow exists at the time of closed economy. When our economy was closed, it means only two sectors exist in our economy. One is household sector and other is firm sector. And in closed economy, there is no relationship with rest of the world. And in closed economy, there is no role of the government. Because classical thinkers always assume that if government does not play any role in economy, then all the activities can move smoothly. So government interference is not necessary according to the classical economists. So in closed economy, we assume that only two sectors exist. One is household sector and second is farm sector. Household provides means of production or factors of production to the farm sector, and farm produces goods and services and give it to household sector for their survival. In this case, there is no transaction done by money. So this flow is called real flow, in which money is not involved, government sector is not involved, and rest of the world sector is not involved. Only two sectors involved, and transactions are based on barter system. Barter system is that system in which money is not used for transaction. Goods can be used for change and exchange, and goods can be used for sale and purchase. So this type of flow is called real flow. But at present, as you know that at present all the economies are open economies. All the economies have relationship with rest of the world. All the economies involved in doing international trade like exports and imports. And no one country is self sufficient for producing all the goods and services in their own country. That's why all countries engaged in international trade, and they are taking advantages and gains from international trade. At present, money flow is exist because at present money is the main important source of transaction. Without money, we can't sell or purchase any commodities or goods and services. So at present, there are four sectors exist in the economy, and these four sectors are: one is firm sector, second is household sector, third is government sector, and fourth is rest of the world sector. These four sectors exist at present each and every economy because at present all the economies are open economies. So at present government play very important role in our economy, and rest of the world sector also play very important role in economy. So at present, which flow is exist? Real flow does not exist at present. Real flow exists at that time when economy was closed. At present, money flow exists, and four sectors exist in the economy: firm sector, household sector, and government sector, and rest of the world sector. These are the four sectors. Same as firm always produce goods and services for household sector and for all human beings of the society or country. And household is the owner of all the factors of production. Household provides all the factors to the firm sector or government sector. If government is producing goods and services, then government will also take these means of production from household sector. And farm produces goods and give income to the household sector, same as government also produces goods and services and reward give to household sector in form of rent, interest, wages and profit. Rest of the world sector engaged in international trade. Firm always exports and imports goods and services from rest of the world, and if we do imports, then the payment goes to rest of the world sector of imports. And if firm do exports, if firms sell goods and services to abroad, then the payment received for exports by firms from the rest of the world sector. Government role is very important because at present government collect revenue through taxation. Government take direct taxes from household sector, and government collect indirect taxes like GST from firm sector. And government does not give any direct reward after collecting the taxes, but government provides subsidies to the firm sector, and government give transfer payments which is called unilateral payments or one-sided payments to the household sector. These transfer payments are like old age pension, scholarship, and unemployment allowance, and donation, gifts, grants, etc. These are called transfer payments. These transfer payments are given by how given by government to the household sector, and firm sector always take subsidies from government sector. At present, financial market also play very important role. Financial markets save money from firm sector, and household sector can save their money in banks and financial institutions. And if they need to borrow money or if they want to invest money in their business enterprises, then they can take loans, and they can take borrowings from the financial institution sector. So at present, which flow is going on? At present, money flow is going on in our economy, and four sectors exist in our economy. This is called circular flow of income, which has two types. One is real flow and other is money flow. Next is national income accounting. Now, what is national income accounting? National income accounting is a set of rules and definitions for measuring economic activities in the aggregate economy because in macroeconomics we always study about aggregates or in totality, like aggregate demand, aggregate supply, total investment, total saving, national income, theory of employment, balance of payment, inflation, unemployment, etc. These all aggregates are related with whole units of the economy. So, national income accounting is a set of rules and definitions for measuring economic activity in the aggregate economy, that is, the economy as a whole. National income accounting is a way of measuring total or aggregate production. So, national income accounting play a very important role in macroeconomics because macroeconomics deals with whole units of the economy. In macroeconomics, national income accounting tells us how we can estimate national income and its aggregates. Next is, what is the difference between GDP and GNP? These are the aggregates of national income. Gross domestic product, it's a very important concept, and GNP is also related with GDP. GDP stands for gross domestic product and GNP stands for gross national product. GDP is the money value of all the final goods and services which are produced in a domestic territory by all the producers in an accounting year. So, GDP measures the domestic levels of production of goods and services in given period of time. It's a flow concept because it is related with period of time, not point of time. And GNP measures the level of production in given period of time of any person or corporation belonging to a country, or in other words we can say that GNP is the total sum of all the final goods and services produced by normal resident of a country in an accounting year is called GNP. GDP is a domestic concept. It is related with domestic territory or it is a geographic concept. But GNP is an economic concept because it is related with normal resident of a country. In this concept, we take the production of goods and services which are produced by normal resident, not all the residents of the country. GDP shows the strength of the country's domestic economy, but GNP shows the contribution of resident towards country. GDP is location based output and GNP is citizenship based output. So GDP and GNP both are very important concept in national income accounting because first of all we have to calculate gross domestic product. After that we can convert it into GNP or NDP or NMP. We can convert in any terms or in any aggregates of GDP concept. So GDP is very important. GDP is that concept which only take output of domestic territory. Now what is domestic territory? Domestic territory is a geographical or political boundary of a nation. In this domestic territory, we include all the territories which is related with political or economic. Economic means where we earn money income. For example, our ships earn money and our ships earn money from foreign countries for transporting goods and services to other nations. In this case, the income which is received by our country, that is called the part of domestic territory. All the income which is related with our domestic territory, that is the part of GDP. And under normal resident concept, we take only that person income which is that person which lives in any other country, maximum or minimum for 1 year and maximum for many years. And if a person live any other country and earn income from that country, is called normal resident of that country. Normal resident, anyone can be become normal resident. If we live in abroad for taking income, that is called normal resident. And for our country, we will be called NRI, non-resident Indian. For example, Indian Indian went to abroad for earning money and for economic purpose and live there for more than 1 year. That person will be called normal resident of a country. For our country, that person will be known as NRI. It means non-resident Indian. So GDP and GNP, the basic difference in between these two concepts are GDP is related with domestic territory and GNP is related with the production of goods and services which are made by normal resident of a country. Next is classical theory of economics. Classical economists are known as Adam Smith. Adam Smith is the father of economics, who gave economics in 1776. Firstly, Adam Smith defined the definition of economics, and he said that economics is the science of wealth. And in economics, we study about money. What is money? How we can earn money? How we can spend money? All these concepts are related with economics. Classical economists are those economists who firstly introduced economics and gave theories. And under classical theory of economics, we take theories of Adam Smith, David Ricardo, Malthus, J.B. Say, J.S. Mill, etc. So classical theory of economics is a theory of economics especially directed towards macroeconomics based on the under restricted working of markets and pursuit of individual self-interest. Classical economics relies on three key assumptions. One is flexible prices, Say's law of market, J.B. Say. The famous law of J.B. Say is Say's law of market, which explains that supply creates its own demand. It means whatever goods and services are produced in our economy, they are immediately consumed by consumer, and there is no problem of overproduction and underproduction exist in the economy. According to Say's law, there is no difference or no gap lies in between of aggregate demand and aggregate supply. It means aggregate demand remains always equals to aggregate supply, and each and every economy can easily attain full employment level. And classical economics assume that saving and investment remains always equal, and if there is an inequality exist in these two concepts, then rate of interest play very important role to equalize saving and investment. So these are the concepts which are introduced by classical economics like Adam Smith, Ricardo, Malthus, J.B. Say, and J.S. Mill in the analysis of macroeconomics. Next is, what are the basic features of classical economics? Classical economics who produced or presented classical theory of employment, the basic features of their theory is, one is assumption of full employment. Classical economics assume that all the economies have full employment. Full employment exists each and every economy. What is full employment? Full employment is a level. Full employment is a concept where all country people gets job opportunities. No one is unemployed when economy is in full employment level. But this assumption is unrealistic because at present no one economy is working under full employment level. At present, full employment is a rare situation and it can't be achieved very easily. And according to Keynes, at the level of full employment, 5 to 6% unemployment may be exist. Because unemployment have so many types like voluntary unemployment, involuntary unemployment, frictional unemployment, disguised unemployment, structural unemployment, and cyclical unemployment. There are so many types of unemployment. And Keynes assumed that at the level of full employment, 5 to 6% voluntarily unemployed people may be exist. That is called natural rate of unemployment. So full employment concept is unrealistic, but it was assumed by classical economics that each and every economy full employment exists, and it can be very easily achieved while making equilibrium between AD and AS. If aggregate demand is equals to aggregate supply or aggregate demand intersects aggregate supply curve, here full employment can be achieved. And they assume that according to Say's law of market, supply creates its own demand. It means whatever goods are produced, immediately they are consumed by consumer. There is no problem of overproduction, no problem of underproduction exist in the economy. Demand and supply always remains equal. No depression, no boom situation occur in the economy. Economy is working under static condition, which is unrealistic because at present all the economies are dynamic economy. Everything is changeable. Nothing is permanent or static or fixed or constant. Next assumption or feature of classical economics is policy of laissez-faire. It means all the economies are working under capitalist economy, and if government does not interfere in the economy, then economy can run very smoothly. They don't assume that government play important role. They don't feel that government need or government requirement is necessary for running economic activities. That's why they assume the policy of laissez-faire. Next is price mechanism. Price mechanism is a system in which price is determined by the forces of demand and supply curve. Demand curve is always downward sloping curve, which shows inverse relationship between price and quantity demanded. And supply curve is always upward sloping curve, which shows direct relationship between price and supply. Where both curve intersect each other, these demand and supply are called two blades of scissors. Where both curve intersect each other, price is determined, and that price can solve all the central problems of the economy like what to produce, how to produce, and for whom to produce. So price mechanism play very important role in economy according to classical economics. Next assumption or feature is price wage flexibility. Classical economics assume that wage rate is fully flexible. If we want to achieve full employment level, we can increase or decrease the wage rate and economy can achieve full employment level. Next assumption is there is perfect competition in labor market and product market. Perfect competition is that market where all the buyers and sellers exist in market in a large numbers and all produces same product or homogeneous product and price remains always uniform. This market is also unrealistic market, does not exist at present, but classical economics assume that there is a perfect competition in labor market and product market. Next assumption is labor is homogeneous Under this assumption, we assume that labor is homogeneous. It means all the units of labor are same. But it can't be possible because the mind and physical ability, capability of all the labor remains always different. Next is perfect information to all the market participants. It means there is a perfect knowledge regarding market price and market product exist in the economy, which also unrealistic assumption does not exist at present. Money wages and real wages are directly related and proportional. This is assumed by classical economics that money wage and real wage both are directly and positively related. But money wage is that wage which is received by the employees after rendering their services, and real wage is related with the price level. If in economy price increase, our purchasing power will fall and our real wages will also fall. Real wages depends upon inflation or price level. While price increases, real wages falls. When price falls, real wages increases. And money wages depends upon the income which is received in form of cash by the employees. So these are the assumptions of classical economics. These are the basic features of classical economics which are presented by Adam Smith, Malthus, Ricardo, J.B. Say, J.S. Mill, etc. Next is Adam Smith. Adam Smith is known as father of economics. Adam Smith is the founder of modern economics, advocated for laissez-faire policies. Laissez-faire policies means economy can smoothly run under capitalism if government does not interfere in any economic activity, then economy can smoothly move on or run all the economic activities. Adam Smith is the father of economics, and Adam Smith is the author of Wealth of Nation. The famous book of Adam Smith is Wealth of Nation. And Adam Smith created the concept of GDP. GDP is gross domestic product, which is very necessary while estimating national income. Next is J.B. Say. J.B. Say presented Say's law of market, and the Say's law of market was very popular during the classical economics time period. According to his law, Say's law of market, which is written on the book A Treatise on Political Economy, influenced by and big proponent of Adam Smith's economic theories and philosophies in Wealth of Nation, taught political economy. J.B. Say said that supply always creates its own demand, and JB Say mainly focused on supply and more emphasis on supply, but according to Keynes, demand play very important role in the economy. But according to Say's law, supply creates and supply play very important role in the economy. Next is methods of measuring national income. How we can estimate national income? What are the methods of estimating national income? Here, three methods are related with estimation of national income. These three methods are: one is value added method. Value added method is known as output method or product method. Second method is income method, and third method is expenditure method. This is also known as outlay method. These are the different methods which we can use for the estimation of national income, because we know that in each and every economy, three sectors exist in the economy. These three sectors are: one is primary sector, which is related with agriculture activities. Second is secondary sector, which is related with industrial activities or it is also known as manufacturing sector, in which we include all types of industries like small scale industry, cottage industry, big industries, large scale industries, etc. And third sector is known as tertiary sector. Tertiary sector is also known as service sector. In this sector, we include banking, transportation, communication, etc. So under these three sectors, we take different methods while estimating national income. In primary sector, we use value added method or output method or product method for estimating national income. And in tertiary sector, which is known as service sector, we take income method of the calculation of national income. And in secondary sector, which is known as manufacturing or secondary sector, which is known as manufacturing sector or industrial sector, in this sector we use final expenditure method for the estimation of national income. Next is, if we want to calculate GDP by these three different methods, then what is the way and how we can estimate or how we can calculate GDP with the help of expenditure method or with the help of income method and output method? So in this first method, GDP, if we want to calculate by expenditure method, first of all, we will take consumption expenditure, government expenditure, investment expenditure, and change in value of stocks. It is also called known as inventories or change in inventories, or it is the difference between closing stock and opening stock. And if we include net exports, net export is the difference between exports and imports. So if we include four expenditures like C plus I plus G plus net export, then we can get GDP by expenditure method. C is consumption expenditure. I is investment expenditure, G is government expenditure, and NX is net export, which is the difference between exports and imports. It may be positive, may be negative. If exports are greater than imports, then it will be positive, and if exports are less than imports, then it will be negative. And change in value of stock is known as the difference between closing stock and opening stock. So these four things are very necessary to add while estimating GDP by expenditure method. Second is income method. If we want to estimate GDP with the help of income method, then first of all, we will take all factors income. Factors are four like land, labor, capital, entrepreneur. The reward of land is rent, and the reward of labor is wages and salaries, and the reward for using capital is interest, and the reward for entrepreneur is profit. If we add all these factors reward in form of rent, interest, wages, and profit, then we can get GDP, gross domestic product. In this concept, depreciation value is also included. And depreciation is the wear and tear loss or maintenance expenditure which always exists while we use all fixed capital assets for production of goods and services. Third method is value of output or value added method, and product method or output method. It has different names. Under this method, if we want to estimate GDP, or GDP means gross domestic product, first of all we will take value added from each of the main economic sector like primary sector, secondary sector, and tertiary sector. All these three sectors give contribution in the production of goods and services. We will take value added, and value added is calculated by taking the difference of value of output minus intermediate consumption. Value of output is the sum total of all the goods and services which are produced in the economy, and all the goods and services in which we include both types of goods like final goods and intermediate goods. But if we include intermediate goods in the estimation of national income, then it will create double counting problem. So to avoid this problem, we always take value added. Value added can be estimated with the help of value of output minus intermediate consumption. If we deduct intermediate consumption from value of output, then only final goods value we can estimate. And these final goods value always included in the estimation of national income. That's why value added is estimated by deducting intermediate consumption from value of output. These are the three methods. Next is the difference between intermediate goods and final goods. Which goods are called intermediate goods and which goods are called final goods? The basic difference. What is the basic difference between these two types of goods? Intermediate goods are those goods which used for the production of goods and services. And final goods are those goods which are finally used by consumer, which is ready to use. Final goods are also called ready to use, and intermediate goods are called those goods which are used for the production of goods and services. Next is intermediate goods are remain within the production boundaries. It means the goods which lies under the boundary of production, that is intermediate goods, and which cross the boundary of the production or which remains always outside the production boundaries, that is called final goods. Intermediate goods in production process, value is added. It means value can be added of intermediate goods. But final goods, in this case, no value is added to final goods. For example, if we use wheat, then we can make so many things from wheat. But if we are taking bread, bread is a final good. It means no one other value can be added of this final good. So intermediate goods value can be added, but final goods value can't be added. Intermediate goods are not included in the estimation of national income, because if we include intermediate goods, then it will create double counting problem. Final goods are always included in the estimation of national income because it is very necessary and it avoids the problem of double counting. For example, intermediate goods are like milk. If milk is purchased by a restaurant, then it will be called intermediate good. If milk is purchased by the household sector or by consumers, then it will be called final good. This is the basic difference between intermediate goods and final goods. Otherwise, any good may be intermediate or may be final. It depends upon their use, how we are using that commodity. For example, if sugar is used by sweets by the sweet maker, then it will be called intermediate good. And if sugar is used by the household sector, then it will be called final good. So any type of good may be intermediate or may be final, depends upon their use of that commodity. This is the basic difference between intermediate and final goods. We must have to learn about this difference because final goods always avoid the problem of double counting and intermediate goods always create the problem of double counting. And while estimating national income, we always take final goods and services, not intermediate goods and services. Next is, what is nominal GDP and real GDP? Nominal GDP is called national income at current prices, and real GDP is known as national income at constant prices or base year prices. Nominal GDP is the GDP of all the goods and services which are produced by the economy at current market prices. And real GDP in this concept, value of all the goods and services produced by an economy, its investment, government spending, and exports. And it is based on constant year prices. Next is nominal GDP is the value of the total product is seen to be higher because it does not reduce inflation. Nominal GDP is estimated on the basis of current year price, and as we know that at present are increasing and inflation exists in our economy. When price level increases day by day, then nominal GDP value will be higher. So nominal GDP always remains higher than real GDP because nominal GDP depends upon current prices and real GDP depends upon constant year prices or base year prices. And base year should be that year in which price remains constant, no inflation, no deflation occur in the economy, and there should be no any abnormalities like natural calamities, flood, earthquake, war, etc. does not exist in the economy. So the value of the total product is seen to be higher because it does not reduce inflation under nominal GDP, and real GDP is the value of the total product appears low because inflation is reduced in it. Next, reliability. According to the reliability, which is more reliable, nominal or real? So nominal GDP is less reliable in comparison to real GDP, and real GDP is more reliable in comparison to nominal GDP. Nominal GDP worth is less, worth is high. Worth is high. Why its worth is high? Because it is based on current year price, and current year only price increases, output is not increases. That's why its worth is high and real GDP worth is low. But real GDP is very necessary or very useful for economic welfare or for social welfare, and nominal GDP is not necessary or not useful for calculating economic welfare or social welfare. So financial growth analyzing is difficult in case of nominal GDP, but in real GDP analyzing is very easy. And according to this nominal GDP, India's position in the world is fifth largest in the world, and real GDP according to this data is not available. So this is the basic difference between nominal GDP and real GDP. Nominal GDP is calculated on the basis of current year prices, and real GDP is estimated on the basis of constant year prices. Real GDP is the true indicator of economic growth and welfare, but nominal GDP is not the true indicator of economic growth and welfare. Nominal GDP increases due to increase in price, not output, but real GDP always increase due to increase in output level, not prices. Next is real GDP and nominal GDP. We can explain the difference between this in this way also. GDP calculated on the basis of base year price, that is called real, and if GDP is estimated on the basis of current year price index, that is nominal GDP. Real GDP remains constant and nominal GDP can be fluctuate. Real GDP calculated on constant year price and nominal GDP is calculated at current year price. Its real GDP is the true indicator of economic growth and nominal GDP is not a real indicator of economic growth. Next is the uses and limitations of real GDP. We use real GDP to calculate the economic growth rate because economic growth rate is the rate or percentage change in the quantity of goods and services produced from one year to the next. Economic growth is a long-term process in which national income and per capita income increases continuously for the long time period. And economic growth rate is the percentage change in the quantity of goods and services produced from one year to the next year. We measure economic growth so we can make economic welfare, comparison across time, international comparison across countries, and business cycles forecast. So this is the uses of real GDP. Next is GDP deflator. With the help of nominal GDP and real GDP, we can calculate GDP deflator. GDP deflator is an index or it's a ratio of nominal GDP. If nominal GDP is divided by real GDP and multiply by 100, then we can get GDP deflator. GDP deflator is the price level of the overall economy, and GDP deflator is the ratio of nominal GDP to real GDP. Actually, it fluctuates. It is the index. It is the measuring unit which can equalize the price level of the constant year and price level of the current year. Next is uses and importance of national income. National income is very useful while we want to estimate standard of living of the country people, because with the help of national income we can get per capita income. If national income is divided by population, then we can get per capita income. And per capita income, if it is higher, then standard of living will be higher. If per capita income is lower, then standard of living will be lower. So national income is very useful in measuring the standard of living of a nation through estimating per capita income of the nation. Time series comparison, if we want to compare according to the time level, then national income accounting is very useful and it is very helpful while comparing two or more countries. National income, when we estimate national income, then we will able to know and analyze the contribution made and performance by each production sector in the economy, and thus taken ample step for rectification. It is very useful in measuring inequalities in the distribution of income. It is very useful in revealing the expenditure pattern of a country. So that's why we can say that national income is very important and very useful for each and every nation. Next is limitations of GDP. What are the limitations of GDP? GDP has so many limitations. As we know that GDP is the real, GDP shows the real picture of the economy. But sometimes GDP does not show the real picture or true picture of the economy, because GDP may be real or may be nominal. If we calculate nominal GDP, it is not the true indicator of economic growth and welfare. If we estimate real GDP, then it will be true indicator of economic growth and welfare. But how we can judge what type of GDP is we calculate? So if GDP increases, then these are the limitations. One is bad. Bads means the things which is always bad for all country people. Crime is bad, and if GDP increases, simultaneously crime also increases. No welfare of the country people will rise. If GDP increases, simultaneously pollution also increases. No social welfare will rise. If GDP increases, but corruption or underground economy also increases, black marketing also increases, then economic welfare will not increase. If GDP increases, simultaneously inequality of income and wealth increases. Rich becomes more richer, poor become more poor. Economic welfare will not increase, so it's a not indicate true indicator of welfare. If GDP increases but infrastructure not increases, then it will be not increase our welfare. If GDP increases but GDP increases due to depletion of resources, due to extra use of natural resources, then welfare of the country people will not increase. So these are the limitations of GDP. Next is problem in calculating national income. There are so many problems which exist while calculating national income. These problems are like double counting problem. When we take both goods price, intermediate and final goods price, then it will create double counting problem. Some transactions are non-market transactions which are related with like if a person gardening in their own home, that person activity is not related with money or not economic transactions, that transaction should not include in the estimation of national income. Some transactions are non-market transactions which are not made by any person for taking payments from the country people. It excludes unpaid activities which did not take place in the market. For example, carpenter who repairs their own home, that is non-market transactions. Underground economy is that economy in which illegal activities, smuggling, and black marketing or corruption, these activities engaged, that is also the main problem while estimating national income. Next problem is externality. Externality is the concept in which one person action affects the others. And if a producer produces goods and services, then environment will be polluted. And this type of externality is called negative externality. Externality may be positive, may be negative, but this is the main limitation of or main problem of while estimating national income. And sometimes we take production of all the goods and services, either it may be capital goods or consumer goods. If in our economy capital goods are producing more and consumer goods are producing less, then GDP will increase but welfare will not increase. And if we have inadequate information or incomplete information, then market will be failure and this will create the problem of estimating national income. These are the problems while estimating national income. It always occurs. We should avoid these problems so that we can get accurate national income. Next is three limitations of using GDP as a measure of welfare. If GDP increases but social welfare not increases, then it will not be called the true indicator of economic welfare. For example, in South Africa is in the top 40 countries for highest GDP. Over 50% of its people live in poverty, meaning they have a low quality of life because they lack basic human needs such as food, shelter, and access to education and healthcare, etc. If GDP increases but the country people's standard of living does not increase, that will not be called the welfare or true indicator of economic welfare. Since GDP does not reflect upon the quality of life, it is limited as a measure of welfare. Problem of double counting is that problem which actually arises if we take both the commodities prices, intermediate goods and final goods. If both the goods are included in the estimation of national income, then it will create double counting problem. And if there is any false information, then also national income can't be estimated accurately. Problem of double counting always arise while estimating national income. If we take both the commodities price, intermediate and final, then this problem arises. So to avoid this problem, we should always take final goods prices, not intermediate goods prices. Thank you. In next class, we will discuss about other topic. Today's topic was national income accounting. Now this topic has been finished. Please read carefully all these topics. Thank you.